How to build a beast stock market portfolio. That's exactly what we're talking about here today, guys. I get so many questions from people all the time on like how to build up a portfolio. Like what's your thought process behind it? Where do you put value stocks versus growth stocks? And all those type of things. How many stocks should a person own? Everything like that. Obviously, every single person's situation is different, okay? So if you're someone that, is not so into as far as researching individual companies, then you might want to own index funds and things like that. But today's video is really more for the stock pickers out there, the people like myself that actually invest their own money in individual stocks and whatnot. And today's video is going to be much more tailored toward the 20 to 30 year old age bracket, okay? Doesn't mean you can't adapt the strategy if you're 40, 50, 60 years old or whatnot. I'm just saying like this is more for the, I guess you could say the younger crowd, the 20 to 30 year old crowd, because of, it's not like a highly risky portfolio, but at the same time, when you're investing in your 20s and 30s, it might not necessarily be the same way you want to invest when you're 60, 70, 80 years old and you're in retirement and things like that and you're just enjoying life. So it's a different philosophy, all right? So that's what we're talking about here today, guys. Also, I just want to let you guys know that I am closing down my stock market membership group to new members starting on May 3rd. So if you want to get in that group, you got to get in it right now. Basically, there's been so many people that have joined over the last 2 or 3 months that I just need to focus on everybody that's in that group right now. So many people comment, I comment back to people, treat them like family and whatnot. It's very time intensive on my part, so I can't really keep letting tons of people in there. So I'm shutting it down May 3rd to new members, and then I'm just going to focus on everybody that's in there. I'm still going to be producing content for everybody that's in there and whatnot, but you will not be allowed to join for at least the remainder of May after May 3rd, and I'll probably even keep it shut down for June. So if you're interested in getting in there, you should probably get in that now. Now, the first thing when I think about as far as like building out a really, a very good diversified beast portfolio is you've got to own at least 4 stocks, okay? I recommend owning at least 4 stocks for every person out there, okay? Anything less than that, it's too dangerous, okay? I've gone off the rails before and invested in less stocks than 4 at particular times here and there, and I can tell you I'll never do that again. I'll never ever do that again. It's a lesson I learned. It was just a dumb, immature thing that I kind of had to go through and realize how stupid that was. So you should always own a minimum of 4 stocks, okay? That's your absolute minimum, okay? But all the way up to around 9 stocks, in my opinion, is where you should be at, okay? Anything more than 9 stocks, if you own 15 stocks, 20 stocks, 30 stocks, 40 stocks, you start getting into a place where it's hard to even know what's going on with those companies. There's so much going on with every single company all the time, okay? So even if you own, let's say, 9 or 10 stocks, right? It's a lot of companies to keep track of, with all the news that comes out all the time, with all the quarterly results, with this and that. There's a lot of stuff always coming out. There's so much information. Never mind that, you're probably going to be looking into other companies to potentially invest in. That's so much work in itself that if you also own 15, 20, 30 stocks, guys, you get into a situation where how do you even keep up with those ones you already own? Never mind have time to look into other stocks. Like it gets too insane, okay? So your focus should really be on these. And also, think about it from a perspective of, you own 20 stocks. Are you going to like stock number 20 even remotely close as much as you like stock number 5? Probably not. I think there are a ton of great deals out there in the stock market right now. I think there's a massive amount of them. But would I say there's at least 20 stocks that I would love to buy right now? Probably not. Is there maybe 10? Yeah, there's probably about 10 stocks that I would love to buy right now. But is there 20? No. And then we're in a market that I feel is pretty cheap right now. But you got to love a stock if you're going to invest in it, right? It can't just be a situation where they're like, oh, it's okay if I put some money in that, because why are you going to do that? Like, that's not smart money move on your part. So you got to own a minimum of 4 stocks, in my opinion, around a maximum of 9 stocks. Now, obviously, if you're older, you can maybe push this number up a little bit. But even if you're older, let's say you're in your 50s and whatnot, I don't know if you still really want to go 20, 30 stocks at that point. That's still a huge amount, okay? I would say if you're going to start going to a place where you want to still individually pick stocks and you want to be in 20, 30 stocks, I would say at that point, just maybe start sticking to index funds and whatnot and just kind of track the market, however much the market goes up or down. That's however much your account goes up and down. Because, like I said, it's too much, guys. It's too much if you own a ton of stocks like that. So 49 stocks is kind of what you want to own. Now, so let's just say, let's do a 7 stock portfolio. That's kind of like my magic number. I think is kind of like the perfect number to own is around 7 stocks, okay? So you own 7 stocks. What do these stocks want to entail? Well, the first one I kind of think about is you got to own an automatic, okay? We'll call it an auto. There are 3 companies I really think of autos as far as being like companies that it's almost a guarantee, you know, nothing is guaranteed in investing. Nothing is guaranteed in investing ever, okay? It doesn't matter what company it is, it's not guaranteed it's going to go up, it's not guaranteed their revenue is going to go up. Nothing is ever guaranteed in this game. But when you think about the companies that are the closest thing to guaranteed money you could possibly make in the market, there are 3 companies, in my opinion, that come to mind. Apple, Google, Facebook. When I look out, you know, 5 years from now, Apple, Google, and Facebook, unless we're in a massive recession at that time, are going to be, you know, way higher as far as their market values go than they are today. Okay, much higher 10 years from now than they are today. When I think about Apple, Google, and Facebook, they're almost like automatics. Okay, they're the closest thing you can get to like guaranteeing making money in the stock market. Okay, so in my opinion, one of your stocks has pretty much got to be one of those 3. Okay, some people own all 3. Some people own Apple, Google, and Facebook. You know, that's your decision. But I almost think you got to own, you know, at least one of those 3 stocks. Now, you might say, Jeremy, but you don't own any of those stocks in any of your accounts. I do technically, because my wife has a massive position in Apple, okay? She has a massive position in Apple, and guess what? His is hers, and hers is his when you're married, okay? So I do have a position in Apple, actually. So an automatic, that's kind of what I think about. Then I think about your second stock is what I really call like your number 1 stock, okay? So your number 1 stock, how you want to think about this one, it's the company that if you had to put every dime in a company because you believed it's going to go up, you know, so much over time, if you had only one company to pick from, that's that one company, okay? That's that one company that you just love, that you just believe in so much, you just think is going to, you know, take over the world or whatever. So you got to have some money in that number 1 company, okay? You know, I've had different number 1s from over time. The majority of them were very good. They were very strong. There was one time I had a very bad number 1. Everybody knows that, GoPro. That was a very bad number 1 I had at that particular time when I should have had Wynn Resorts as my number 1. Wynn Resorts was actually my number 2 stock. It should have been my number 1 because that was the one I ended up killing it on, right? But it's got to be that company that you would just like believe in that company so much. Like you look out to the future and you just believe in that company so much, okay? It could represent some growth. It could represent some value. It just depends and whatnot. By the way, real quick, I'll just share this with you. In my opinion, in a beast portfolio, you should own only profitable companies, okay? That's my personal opinion. I think you can get hurt very badly with unprofitable companies. I messed with one unprofitable, maybe 2 unprofitable companies in my entire investing career that I can remember. One was Pandora, which I owned back in, I was like 2011 or whatever. Lucky enough, I did not get hurt by Pandora. The other one was GoPro, and I got hurt severely by GoPro, okay? So I would say stay away from unprofitable businesses, okay? You want to build a real beast portfolio, build a beast portfolio that's around companies that actually make money on their bottom line, okay? Stick to those type of companies. So your number 1 is your next position. Then the way I think about stock 3 and stock 4 is I think about you got to own, you know, 2 growth, okay? Stock 3 and stock 4 should be more growth focused, okay? So something that has big potential out there in the future, you know, they got some big growth vectors ahead of them, you know, some things that are going pretty good. Now, these companies, just because they have growth, doesn't mean they don't have any value, okay? Or you're going to invest in like crazy high PE companies or something like that. You don't want to be in that type of position. At the same time, you don't want to be in the type of position that these companies have nothing going in the short term, okay? If all you got is potential long-term prospects out there, that's a bad investment in my opinion. That's risky, man, because you're betting the farm on what could potentially happen, but it might not happen, okay? They got to have something going already for the business, if not multiple things going for the business, that makes you want to invest just based upon what they're doing now. But these companies also have something out there that it's like, wow, this potential, as long as they execute on this is going to be massive for the company. So you got to really think around growth, okay? And then you got to think stock number 5 and stock number 6. These are going to be more value plays, okay? These are going to be more value plays. So these type of companies are generally going to be low PE companies, okay, lower than whatever the market's trading at. So let's say, you know, the market's trading at an average forward PE of 15. Then you're probably going to want to find some value stocks that are somewhere around, you know, a 12 or 10 or maybe under 10 in the value space. Companies that, yeah, they might not have, you know, this type of thing that, well, the company could potentially double or triple over the next 2, 3, 4, 5 years like these companies could. But these companies are more of a safe bet, okay? These are more sure things, like they're very low PE, you're getting them for bargain basement pricing, and they're not businesses that are gonna go out of business, okay? So if you're investing in businesses that are like, don't have brand strength and things like that, and their business is just falling apart completely, it doesn't really matter what PE they're at, okay? People, come to me sometimes, they're like, oh, look at this stock, it has a 5 forward PE on it, or 7 PE on it, or whatever, and it's like, okay, but look at where their business is going. It's trending so far south, like why would you want to be in that stock? These are companies that are still pretty strong. It's just they've fallen out of favor with Wall Street. Maybe they used to be a growth stock. We see this a lot of times where one of these growth companies, okay, they're reporting phenomenal numbers. They're growing, they're growing, they're growing. And next thing you know, the growth starts to slow, but they're all of a sudden making lots of profits, but Wall Street, kind of goes away from it because they're not in the growth phase anymore, and the growth investors lead that stock. And then value investors hadn't really been looking at it because it was a high PE name. Then it comes down big time, becomes a low PE name. Value investors start to look at it and say, wow, this company, might still have some things going ahead of it. It's not going to be huge like it used to be, but look at how much money they're making now, right? And so they look at it from that perspective and they say, wow, that's a good value. And then the last one is a very small position, okay? And this is a spec stock, okay? This is a spec stock, which I don't have a problem with. This is, a company that is very speculative, okay? But you're gonna wanna make sure you're not investing more than 5%. Like less than 5% of your money should be in a spec stock. Less than 5%, okay? Really maybe like 2 or 3%. It's just something that kind of keeps it interesting. Like it's almost like the lottery ticket stock or something like that. You call it a spec stock, something that, a company you found and they got such huge potential in this industry. The issue I have with spec stocks sometimes is some people have spec stocks as like their number 1, 2, or 3, like you're crazy having a spec stock up there, okay? These are lottery ticket stocks. They're fun to play with, but they're not fun to play with big money, okay, guys? Because the chances are that spec stock is not going to develop into what you thought it was going to develop into. It's highly risky, okay? Spec stocks are highly risky, so you don't want to bet the farm. A lot of people have these high, these spec stocks as their number 1, 2. That's crazy, guys. That's crazy. This is just meant to kind of keep things interesting for you, okay? It's kind of like keep things fun and kind of like a fun stock to have, because the rest of them, they might not necessarily be, fun stocks to have. Hopefully they're all money makers for you over the long term. But in terms of like, can they make you, a millionaire overnight or something like that? That's only going to come from a spec stock. But don't risk the farm on spec stocks. That's just crazy, guys. Even if you have smaller amounts of money, sometimes people are like, I only got $1,000 bucks. Like, what am I going to make? If I invest? Like, your thought process is wrong if you're thinking like that. Your thought process should be around building and growth. It doesn't matter if you got $1,000. It doesn't matter if you got $10,000 or $100. Your mindset should just be around growth. And how do I grow the money I have right now into more money? That's the name of the game. That's what investing is at the end of the day, okay? It's all about risk versus reward. What can give me the least risk possible, but the most reward possible? And that's kind of how I think about this portfolio. So then let's talk about like how much should you have invested in each of these. Obviously the spec stock, we already talked about that one, like less than 5% of your money for sure. Maybe 2%, 3%, and maybe you don't even want to invest in a spec stock. There's nothing wrong with that. I think it's just something interesting to keep people interested because it's something that's like a lottery ticket stock, I guess you can call it. So obviously the majority of the money is going to be concentrated up here, okay? In the automatic and also in the number one, your number one dog as far as like the one you just believe in so much. A lot of your money is going to probably be concentrated up here. Maybe 50% of the money is going to be up here, okay? Somewhere around 50%. And then between all of these, probably somewhere around 45% or so will be in these, okay? So 45%, let's say, so 50%, 45%, let's say you got 5% in that spec stock. Somewhere around there is probably where you're going to want to be. You're obviously going to want to be heavily invested in the automatic because it's almost the most guaranteed thing in the market. Nothing's guaranteed, but it's pretty close, okay? And you're number one. Like, you believe in that company so much, you know that's the number one company you believe in more than any other. You're going to want to be pretty heavily invested in that because, you know, unless you make a big mistake or you go away from your philosophy, like investing in an unprofitable company or something like I did, you're probably going to make money in that number one because you research it so much and you love it, right? What are the chances you're going to mess up on that? Probably pretty slim as long as you stuck to your strategy. Then you got about another 45% of your money concentrated over here. 2 growth stocks that have the potential, you know, to double, triple the company over the next, you know, let's say 3 to 5 years because of different things going out there. And you got your 2 value plays, which are lower PE companies companies, but also represent a good value as far as their business aren't falling apart. They're doing things like that. And that's kind of where I think about like a very well diversified portfolio, okay? Now, at the same time, make sure you're not picking stocks that are all in the same industry, okay? So if you're in the, Apple, Google, Facebook, right, which is your auto, those are obviously tech related companies, all right? So your number one stock, I would probably suggest it not be tech, okay? If your auto is in tech, right? Probably be something other than tech, okay? Maybe it's industrial, maybe it's, I don't know, recreational products. Who knows? Maybe it's, I don't know, lingerie or something. Maybe it's retail. Maybe it's something like that. Like you're going to make sure that's a little different. Your two growth stocks, you're not going to want them to be exactly in the same industry. You're going to want them to be very different, okay? So, people might think, sometimes, stocks get discounted at the same time, right? Cirrus Logic right now and Skyworks Solutions and pretty much all the semiconductor stocks are near 52-week lows right now, okay? So it looks like it's a bargain for all those stocks, but it doesn't mean load up the bank on all those stocks right now. It would be a bad move, in my opinion, to do all those stocks at the same time. Pick out the number one or two ones you like the most and stick the money there, okay? Then find another industry that you think's got a lot of growth and go from there, guys. To just go all same industry, that's a big mistake. You want to be diversified in your portfolio. It's about diversification. So if you got all tech stocks, if all your stocks are tech, you're not diversified, man. If all your stocks are tech, okay? If all your stocks are semiconductor companies, then you're insanely not diversified, right? Or all in the same, imagine if you had, let's say Apple is your number one, your auto, and then you got, Cirrus Logic, Skyworks Solutions, you got Qualcomm, you got Intel. These are all companies that are also very related to Apple. That would be a bad decision, guys. You don't want to do something like that, okay? Also in the same, context, you don't want to do everything that's like, cloud companies. There's a lot of companies in the cloud right now. So imagine if you own Amazon, Google, Microsoft, Dropbox, all those companies in the cloud. Be a bad decision because then you own a bunch of companies that get a lot of their business from the cloud. That's great when cloud's going strong, and then all of a sudden cloud weakens, sales for cloud products start weakening, and those stocks start falling, and then your whole portfolio gets hurt, okay? So make sure you're being diversified. Don't just be all in, when I think about my portfolio, I own, we could say Apple. My wife owns that. That's, the biggest tech company in the world. We own Callaway Golf, which is a golf company, or like recreational company, I guess you can call it. We own Toll Brothers, which is a home builder, very, very different than all those other businesses. We own, obviously, L Brands, which is Victoria's Secret and Bath and Body Works. It's a very, very different, product than what the other companies sell, right? They're just, we go down the list. I'm very, very diversified across my portfolio. That's how you want to be. You want to be in a diversified situation where you're not all in just one sector and whatnot. So that is how I think about building out a beast portfolio. If you want to go for dividends, I actually have a dividend. I'm building out a massive dividend portfolio. So check out that video on the channel. That one just kind of goes into like how to build out a dividend portfolio if that's something you're interested in. Like I said, I got a video on that on the channel. It's a pretty popular video. I think it's got like 40,000, 50,000 views. Might have more views than that. I don't know. I haven't looked in a while. But this is how I think about, just a regular portfolio, how you build it out and whatnot. So hope you guys enjoy this. Hope you got a lot of value out of it today. And anyways, thank you for watching and have a great day.